Hey, this is Ralph, and in this video I want to look at some historical stock return data so that we can determine appropriate expectations for various buckets of risk and reward in retirement funds. I know that's a lot to say, but basically I want to look at this bucket concept of planning retirement funds where short-term needs are met with very low return, low risk accounts, and longer-term retirement funds are met with the hopefully larger, higher risk, higher return accounts. Now, to do this, to analyze our data, I'm looking over at the Stern School of Business, NYU, and they've got a bunch of historical data. And I'll have a link for this webpage in the video description so you can grab it yourself. And I want you to create this Excel worksheet yourself. It's going to take a few videos for us to kind of create this retirement accounts plan. So they do, obviously we could import data into Excel. That would be pretty easy. They even but they also provide a link to an Excel file where you can grab this data. So that'd be pretty easy. So let me go ahead and click on that, and I will just go ahead and open it up. And there we go. So now we get all of this data. Now, they got a lot of stuff on here that could be pretty interesting, and it's all broken down, so that looks pretty good. So if we got all this raw data for the S&P 500, that looks pretty cool. I think what I'm going to do, just to kind of simplify my life a little bit though, I'm just going to grab these first two columns of data. I'm going to copy that. Now I've already got a blank spreadsheet open where I'm starting from scratch, and I will just paste them right into there. So now I can see that I've got all of this information. I've got the years and I've got the returns for those years. Now you'll notice this is S&P 500 including dividends. So many of the stocks in the S&P 500 pay a dividend, and this is assuming that these dividends are reinvested. So that actually creates a slightly higher return, but that's realistic. The alternative would be, every year drawing money out, getting the dividends as maybe an alternative income or something. So that's what that means, includes dividends. Now what I want to do next is I want to create some new rows right above this. So I think I'll just select these first few rows and insert. And I want to keep track of a few key things. For instance, the max, the min, and the average. That's pretty good. And then I'm going to go ahead and take the max equals max. I want to find out what the largest return over these various years are from 1928 to 2020. Okay, that looks pretty good. That down, and then I can just tweak these a little bit. We're going to go ahead and do the min, and then we will also do the average. Perfect. So we can see on a year-by-year basis, the highest return was 52%, the lowest return was a negative 43%, and the average return is about 11.5%. So if you are doing some pretend forecasting into the future, that's where you could say, okay, well, if I estimate 11.6% or 11% or even 12%, then I'm basing those predictive returns off of that. Now, of course, historical returns don't predict future returns, but we're using it as kind of a baseline to understand what's realistic. We don't want to predict that we're going to invest in the stock market and make an average of 20% going forward, and we don't want to predict that we're making 2% going forward because these investments show otherwise. Okay, well, that's pretty good to know. However, that's year by year. What I'm really curious about too are some rolling averages. So what if we had a rolling 5-year and also a rolling 10-year? Now for my rolling 5-year, what I'm going to do is I can do this, I think I'll start right around here. And I'm going to do equals average, but I'm going to average 5 years of annual data. And that's going to give me this result. Okay, so for the 5 years, 1928 through 1932, the average was a negative 8% return. So that would be a loss. Now I can take this rolling average and just drag it all the way down. And then we'll start to see some differences. Okay, well, that's pretty good. But then I'm also going to do that 10-year average. And that should be 10 about there. Drag this all the way down, or double click on that fill handle, Excellent. Okay, so now I've got some information that I think can be kind of enlightening. Check this out when I bring this over here. Drag them over, and here's what I want you to look at. So for an annual average, for annual returns, the high is 52%, the low is negative 43%. That's a huge variance, and the average is 11.64. However, if you invest over 5 years, the high is 28%, the low is 11.6%. I'm sorry, the low is negative 8%, and the average is still 11.64. Yeah, so that's pretty cool. So basically we can see that by investing for 5 years gets you basically the same average return. Those are slightly different numbers, by the way. They just look pretty darn close. So you can get the same average return with less variability in those returns. And then very similar, look at this. If we look at 10-year periods, the high is 21%, but look at that. This is basically saying since 1928, there has never been a 10-year period in the stock market where you've lost money. Pretty neat. So if we're investing for 10 plus years, the odds of losing money in the stock market basically are about zero if you rely on that historical data. And the average return is actually a little bit higher. So clearly investing in long term in the stock market, 10 or more years, is the way to go. Now I'm going to use this information in our next worksheet so that we can start to build up our bucket retirement plans. Thanks for hanging out with me.